Tomorrow is going to be a very interesting day for all Tesla stock investors, or really for anyone with a portfolio in our markets. Microsoft and Google, these two stocks account for over 16% of the market weighting in the NASDAQ. One of them is down big in after hours. One of them is up big in after hours. I worry about this specific thing, and I want to get into that here in this video with you, as well as give you an update on the Middle East. Things are really popping off, if you will, overnight. It's now almost morning overseas, and things just don't look like they're getting better. This is still, I believe, the biggest negative catalyst that we have going for our markets, with the highest probability of giving the markets a negative reaction. So we have an update on that front to bring you, no pun intended. On top of that, we do have earnings coming out tomorrow, a specific trade idea that I like a lot that I will share with you guys towards the end of this video. Some Tesla stock news to get into. I want to look at the technicals for Tesla as well. Very encouraging what we've seen today, and the best could yet be to come. We're also going to get into the option activity that we've seen on Tesla stock today. That's also very exciting. Tesla is one of the most bullish stocks in the land of options that you can find out there on the markets right now, considering Tesla's last earnings that we just got a couple of days ago was not exactly peaches and roses. Well, this is really good. Let's not discredit what is good and what is bad, and we're definitely seeing some good things right now for Tesla. But ultimately, there's two things that affect Tesla: the broad markets and Tesla news. And we're getting a lot of headwinds in the broader markets. And a major recession indicator that is about to flash a red warning sign, which is the yield curve inversion. It's uninverting. That is 8 for 8 in predicting recessions. But what happens when you actually uninvert might shock you. Yeah, the bulls are going to like that one. Let's go ahead and get into all of this information. We have a lot to cover in a very short amount of time. Hit the like button if you own Tesla stock and you're looking to buy some more on any weakness. Hopefully that's a bunch of you guys. Let everyone know you're looking to buy the dip. This is a roll call here in this video, as well as subscribe to the channel if you guys want to stay up to date with what is going on with Tesla stock each and every single day, as well as the broader markets. Both things that move Tesla stock and ultimately move your portfolio. First things first, Microsoft is the winner here in after hours. Microsoft is up 3.89%. It's not a crazy big move compared to other stocks, but Microsoft is a $2.5 trillion company. So it's quite the move. If you take a look at their numbers, revenue beat by about $2 billion, gross margin beat by 1.45%, operating margin was a real standout. That beat by 3.36%. Year over year, revenue was up 12.8%. Gross margin year over year up 1.98%. Operating margin year over year up 4.66%. EPS beat by 27.2%. Operating cash flow beat by 31.8%. And unearned revenue beat by 12.1%. And Google is your big loser. Google is down about 6% here in after hours. They actually had really good earnings, but in this market environment, if you don't beat on everything, you're going to get punished, especially if you're trading near all-time highs, in which Microsoft and Google were both trading near all-time highs when they reported earnings. So, top line revenue on Google beat by about $1 billion. That was a beat of 1.4%. Total services beat, again, by about $1 billion. A beat of 1.5%. Operating income missed by 0.5%. Operating margin on gross revenue missed by 0.30%. But free cash flow, guys, beat by $5.4 billion. Wall Street was expecting $17.19 billion. Free cash flow came in at $22.6 billion. That's impressive. And your year-over-year numbers are even more impressive. Gross revenues up 11% year-over-year. Total services up 10.8%. Operating income up 24.6%. Traffic acquisition cost up 6.9%. EPS up 46.2% year-over-year. Free cash flow up 40.6% year-over-year. And Google still got sold 6% following earnings. It's amazing Tesla was only down 9% after earnings when you look at some of these numbers, especially on Google and the reaction you're getting from the markets. Now, the problem that we could see coming tomorrow is if investors sell off the Microsoft earnings gain. I doubt Google's going to do well tomorrow. They're down 6%. I wouldn't count on them. But Microsoft, if investors sell that off, markets are going to get bloody, and they're going to get bloody quickly. Take a look at NVIDIA earnings. NVIDIA had way better earnings than Microsoft last quarter. And NVIDIA rallied about 10, 12% initially, and then sold it all off the next day. If something similar were to happen with Microsoft, we're going to have big problems on our hand. Currently, the NASDAQ, or the QQQ, the NASDAQ 100 technically, is down about 0.25% here in after hours. So you are by no means out of the woods when it comes to downside upon earnings season, and seeing the reactions of these trillion-plus-dollar companies following these really good earnings. Let's be honest, Google and Microsoft had really good earnings, especially on your year-over-year comps. And Google's still down 6%. That's pretty bearish. That's a bearish sign. You miss on one thing and your stock's losing hundreds of billions of dollars in market cap. You better watch out below when we get real bad news. Now, I'm very excited about what we've seen today with Tesla. Tesla was the real outperformer here on the day today. You did get a Wyckoff candlestick, which is not exactly great. That means we found a lot of sellers up here in this 220 range. Tesla at one point was about $222 per share briefly. And then you kind of came back down. You were above 220 for a while, and then you did sell that off towards the end of the day, as the markets did also sell off a couple points throughout the day. But Tesla stock indeed closed above its 200-day moving average. Tesla stock closed at $216.05. including this drop here in after hours of 0.22%. Your 200-day moving average is at $215.70 per share. I literally can't even believe the bounce back that you have seen in Tesla. That's a strong bounce back. To not even get rejected at your 200-day moving average on the upside as resistance, that should have been strong resistance. It was not. You basically gapped up above it today, which is just a wild concept given the last 2 days or so we've seen some pretty aggressive selling following Tesla's latest earnings. This is a clear sign to me that if we do get a decent market, we don't even need to see a super bullish market. But if we get a decent market like we did today, Tesla stock is going much higher from here. Tesla outperformed the NASDAQ by what it usually does. 2x. I say it all the time. Tesla has a beta of around 2. It's going to double whatever the markets do. NASDAQ was up almost 1% today. Tesla was up almost exactly 2%. Vice versa. On down days, Tesla stock's going to fall more than the broader markets, specifically the NASDAQ. Now, if you take a look at the option activity, it's not just the technicals and the strong bounce that you've seen over the past 2 days that is exciting. The option activity is off the charts bullish. Like off the charts bullish. For today, you had 814 orders totaling $1.06 billion with a positive order value of 70%. Now, someone in the comment section of one of the last videos made a really good point that some of this positive order value could be hedge funds or institutions that have short positions that are hedging out those short positions. That's true, but positive order value is still positive order value. And I think that's a big point you need to also distinguish. You can be short on a stock and not have calls to hedge it out. It's usually not the best way to go. Usually there's a mixture. You're not always going to be one-to-one hedged out, meaning if you're shorting 100 shares of Tesla, you're not always going to own one call to hedge that out. So net, you're seeing very positive option flow activity with Tesla ever since earnings. The day after earnings, the day of earnings, yesterday, today, It's all been super, super positive. And I think there's a couple different reasons for this, right? Bond yields the last 2 days have been falling off of a cliff, best represented by TLT. TLT yesterday was up 1.20%. Today, TLT was up 1.32%. This is an ETF that tracks the 20-year Treasury yield. You have seen some of the highest volume on TLT that you've ever seen. You've actually never seen volume this high on TLT before. Back here during this week of August 12th, 2021, you had volume of 177 million. And just last week, you had volume of 295 million on TLT last week. This probably is going to mark a bottom. Bill Ackman yesterday said he covered his bond short, and it looks like a lot of people are also doing the same thing. Yields going down, well, number one, it helps boost the valuation for stocks, right? But yields going down also has a real effect on the markets, right? On the real stage economy for Tesla's business. It helps multiple expansion, but it also makes it easier to finance a Tesla, which helps Tesla's business. So those are the, I guess it's one technical reason, but those are the two things that are really helping Tesla right now. And then I think it's safe to say, if you're looking ahead for a stock that's growing, revenues and EPS 35-40% year over year, heading into a year where you have seen the fastest increase in the Fed funds rates, which was 2022 and 2023, that you have ever seen. You've never seen the Fed go from 0 to 5.5% within 18 months or so. That's never happened before. And next year you're expecting rate cuts. Well, Tesla is a pretty good place to be positioned. So if you're looking specifically at Tesla, there's not a lot of negative things that you can say. It looks really good across the board. Strong reason to own Tesla, again, with what I just said about rate cuts in 2024 and Tesla being able to put up these kind of numbers when rates are 5.5%. Next year, Tesla's going to be able to raise prices, raise margins. You're going to have the Cybertruck, the halo effect, probably a licensing deal for FSD. At the bare minimum, you get some rate cuts, and that should help Tesla's business fundamentally. So, strong reason to own Tesla heading into 2024. Markets are forward looking. 2023 is basically over. It's all about 2024. You have very strong charts here, a very strong bounce back relative to the drop that we just seen. You should have got rejected around that 200-day moving average. Instead, it's almost like we found support at that 200-day moving average today after we broke it. There was almost no hesitation to break above that 200-day moving average. I rarely, and I mean rarely, ever see that with any other stock. And then you also have very positive option flows. But this is Tesla specifically. Remember, there's two things that moves Tesla stock. Tesla and Tesla news, Tesla charts, Tesla options, Tesla bulls, Tesla bears, and then the broader markets, in which tomorrow is going to tell you a lot based on how Microsoft specifically trades. Again, if investors sell off Microsoft on the open, this market is a lot weaker than a lot of people want to realize. Now, on that note, if you look at the yield curve inversion, which is uninverting, well, if you've watched any of my videos, basically any of them, pick one out, and we're probably talking about the yield curve uninversion at some point. That's because it's always been accurate. Whenever you have had a yield curve that is inverted, you have went into a recession. But normally, ever since the 90s, right, you haven't actually seen the recession until this uninverts. So normally when the inversion happens and this blue line goes under the black line, it's not really a time to panic. Like, people were not really panicking about, this huge recession, even throughout 2023, right? 2022. There was, more of a recession priced in then, but people were not panicking due to the yield curve inversion. Well, now it is rapidly uninverting. And what actually happens when you uninvert on the yield curve is, I would call, shocking. Take a look at this picture of the S&P 500 And these are your moving averages, the 20-day, 50-day, 200-day moving averages. And these black lines, well, I should say this bottom chart is the 10-year treasury yield and 2-year treasury yield. So when it's red, that's when they're uninverted, right? So you were uninverted back here in the 2000s, uninverted back here in 07, 08. You're massively uninverted right now. But what do you actually notice that happens when you uninvert? Well, I should say normally when you are inverted, stocks rally, right? Pretty, like 100% of the time. Well, when you uninvert, you normally see a blow off top kind of rally, especially in recent history. Back in 2000, not as much. And I think that was just the tech bubble and the way valuations were at the time. Back in 07, you went uninverted, you rallied another 5+%. Back in 2019, you rallied around 10% after you uninverted. And now, well, who knows? If we go uninverted again, does that mean we get a final last-ditch rally before we fall? I bring this up because I think a lot of people are positioned with hedges right now, and I do have some on my portfolio as well, so I'm not to single anyone out. I have hedges on my portfolio. If you have short-term hedges, if we do get this same phenomenon that we've seen in the past where stocks do rally after the uninversion, well, your hedges could get blown out if they're on a short-term basis. So this chart almost makes you want to wait to hedge out your portfolios or to fully hedge out your portfolios. But then again, there's the Middle East conflict and the rest of earnings season, which could throw us a couple wild cards. It is being reported to us here tonight, quote, according to U.S. defense officials, the Army is currently scrambling to deploy at least 12 air defense systems to multiple countries across the Middle East before the Israeli invasion of the Gaza Strip is set to soon begin. A terminal high-altitude area defense battery for use against ballistic missiles is currently on its way to Saudi Arabia from Fort Bliss, Texas, while at least 11 MIM-104 Patriot surface-to-air missile systems from both Fort Liberty, North Carolina, and Fort Sill, Oklahoma, are headed to locations in Kuwait, Jordan, Iraq, Saudi Arabia, Qatar, and the United Arab Emirates. So it looks like we're even positioning for what could be an attack from Iran. This is just not comforting to the markets. Syrian state media is also reporting that a headquarters for the 5th Armored Division of the Syrian Army within the town of Isra was destroyed tonight by Israeli airstrikes, with further reports that a radar battalion and weapons depot of the Syrian Air Defense Force were also targeted tonight near the town of Kafara. This was apparently in retaliation for a rocket attack earlier tonight on the Golan Heights. In a little more troubling news, U.S. Central Command has now announced that 24 American servicemen were wounded on October 18th as a result of a drone attack on Al-Tanf military base in southern Syria, which caused 20 injuries, followed by a second drone attack that same night on Al-Assad Air Base in western Iraq, which caused 4 injuries and the deconstruction of an aircraft hangar containing a small plane. The 24 U.S. service members have all since returned to active duty. You're starting to get an escalation of this conflict. And it looks like another 8 Hezbollah members have been eliminated overnight tonight. Now in total, 39 is the total number. French President Macron proposed today that an international coalition fighting against ISIS be widened to include the fight against Hamas in Gaza. That literally sounds like the start of WW3. The markets only briefly reacted to this news today, but if this conflict does continue to escalate, then we have a problem. And I've said it before and I'll say it again. When Israel makes their incursion into Gaza, that's when the stopwatch, whatever analogy you want to use, that's when it starts. That's when this situation could really escalate. So until that happens, I think we're okay. The problem is we're like 12 hours behind. So right now it's daytime over there, or it's early morning time over there. You're not going to have time to react to it if that incursion does happen. It's probably going to happen in the early morning time. It's probably not going to happen overnight. So you're more than likely not going to have time to hedge out your portfolio to trade that event, because it's just going to be overnight for us in the US. Now, I also want to share this chart with you guys again. It is pre-election year seasonal patterns since 1949, and the NASDAQ since 1971. You can see the worst 4 months are July through October, and even November's a little bit choppy. You do tend to rise in the beginning of November, fall towards the end of November, and then December tends to be a really strong month. A lot of this has to do with the Santa Claus rally. It tends to be one of the better periods for markets, really heading into the end of the year. So we'll see what happens. The historical precedence looks good towards that end of the year rally, but I think earnings season, I think the Fed and data is going to be very important, especially on Thursday, as well as this Middle East conflict that makes this year a little bit harder to predict and potentially more volatile and skewed towards that downside reaction. Good news is, if you are an investor in our markets, right now is some of the cheapest periods of time to buy stock. Now, what's actually most interesting to me, and where I find the most value in, buying stocks right now in 2024, is take a look at the green and the blue lines. What do you notice? Well, I should say the green is the S&P 600 and the blue is the S&P 400. So it leaves out, it's basically incorporating your small caps into this. Well, normally, any other time in history, your small caps tend to have a higher valuation than the S&P 500. Like, consistently have a higher valuation. Besides periods of like crashes, right? Then your small caps tend to crash more than your large caps. But any other time throughout recent history, small caps have had a higher valuation than large caps, S&P 500. Well, right now you can see your small caps have pitifully low valuations. You have not seen valuations this low since the bear market back in 2011, briefly when stocks touched their lows, and then subsequently during the 08-09 bear market and the crash that you experienced then. The S&P 600 is trading at 11.7 for a forward PE ratio. That is for earnings next year. You just haven't been this cheap in a very long time. If you look at S&P 500, you're trading roughly at the same level you were back in 2017, 2018, and right before the Rona crash. So you're not super cheap, but you're also not very expensive on the S&P 500. Problem is, again, you can always point out the problem. The problem is your large cap stocks. That's the only place where you have higher valuations, for the most part, on a market weighting basis. If your big tech stocks were to get knocked, looks like Google has already got knocked, Tesla's already got knocked. If Microsoft does see a sell the rally event tomorrow, if Apple falls, you could see a sharp pullback in the indexes and then potentially a recovery of everything. So one more flush out is probably in the cards, if I were to imagine, to get the S&P 500 to reset its valuation and then to see everything kind of recover from there. S&P 600, 400, they've already seen the reset. It's already happened. And what is also interesting, if you take a look at Goldman Sachs' prime book for the cumulative U.S. short flow, short selling is through the roof and short covering has kind of fallen off as of recently, which could explain some of that downside reaction that we have seen in our markets. Tomorrow, you are also going to get some important earnings pre-market and after the bell. Pre-market, Boeing, Thermo Fisher, and T-Mobile. Those are really the big ones for tomorrow pre-market, although they're not going to cause a big effect on the markets. After hours tomorrow, Meta, IBM, and ServiceNow are your big guys. You also do have Mattel, QuantumScape, Align, Baker Hughes, and O'Reilly Auto Parts, which those ones can be big movers. The trade that I'm really looking forward to is ServiceNow, and we'll get into that a little bit more here in just a moment for those of you guys that made it this far into the video. What I find really interesting about tomorrow is Meta obviously is going to move the markets, right? It typically does. But Meta's average move following earnings is 14.8%. The options implied move is only 9.2%. So we're actually not expecting the average move from Meta coming tomorrow, which does kind of suggest to me we're probably going to get a quarter that is in line, at least to the most part, with the estimates. If we don't, if something misses, like you see with Google, well, you could get destroyed, Meta. Now, I was already looking at ServiceNow as potentially making a downside trade on this, and then what do I come across? This guy on X says ServiceNow, strong sell. Now it will crash post earnings. He said that 2 hours ago. Obviously, who knows, right? These trades are more or less gambles based on some data to back them up. Now, one of the things that I really like to do when I'm looking at stocks to trade for earnings, one, it's all about risk mitigation and risk management. So we have a specific strategy we like to employ that, you know, tends to work out more times than not, and that's what it's all about. You're going to lose some, but let's try to make your losses manageable instead of just YOLOing on everything. And feel free to YOLO on some things if that's your cup of tea. I'm not a financial advisor. I'm not a financial planner. Don't listen to anything I say. 87% of options expire worthless. But a YOLO every now and again, I'm not opposed to that. I do that personally myself. But obviously, it's not the best way to trade. What I find very interesting is if you look at the put to call ratio on ServiceNow, well, number one, it's at 1.19. So just on an overall basis, it's high. But if you look at the put to call ratio and the open interest for the last 1,000 days, well, you have seen a put to call ratio of 1.23% over the past week. On Monday, you've seen a put to call ratio of 1.41 and volume of 1.45. And on Monday, or, well, technically today, this is like lag behind one day, as far as right here. Today, you had an open interest of 1.41 and a volume of 1.45. Now, the higher, the more puts you have. So if you have a put to call ratio of 1, that means for every 1 put, you have 1 call. If you have a put to call ratio of 1.5, that means for every 1.5 puts, you have 1 call. That just means there's a lot more puts relative to calls. And you see this here in the open interest and the volume. Open interest of options that expire this week, 46.82% calls, 53% puts. If you blow this up on the bubble chart, expectations are really all over the place. On one hand, the call side is predicting you could hit 655 on good earnings, and the put side is saying you could hit 460 on the downside, which the stock is currently trading around 550. So that would be quite the move. It is an expensive one to get into, but there's not crazy levels of option activity as well. That's why I do potentially like this one for that downside move. Usually if you do see a stock with a lot of option activity, you usually don't see those big moves. Who knows? I could be wrong. Obviously, I'm not a financial advisor. I'm not a financial planner. Anything can happen. Again, but some of these trades, like the January 17th, 2025 430 put worth almost $600,000 today. A January 17, 2025 530 put worth $1.14 million. You can't even find a call position on here. So just looking at the put to call ratio, looking at the sentiment out there for ServiceNow, maybe they're going to miss on something. And a miss right now is, well, you're getting beaten down following earnings. So let me know if you guys have other information you would like to add to that trade. Are you bullish on ServiceNow? Are you not? The stock's up about 50% within the last year, so it's not exactly a stock that has already felt the pain. It's very much been a stock that some people have been hiding out in. As you guys know, the big day for economic data is going to be Thursday. You're going to get durable goods orders month over month and that GDP growth rate. That's a catalyst we've been talking about for well over a month. You're expecting over 4% GDP. We would be the fastest growing country, like literally in the world, especially in the developed world. Crazy numbers that we're expecting. But tomorrow, you are going to get the Bank of Canada monetary policy report. Yesterday or 2 days ago, we were expecting Canada to actually raise rates. Now it looks like we're not expecting them to raise rates. A continued pause is what we're expecting. If they do raise rates or they were to cut rates, that can have implications for our markets. But if they give us what's expected, markets are not going to react to it. Now, you're also going to get new home sales coming out at 10 o'clock in the morning. That Bank of Canada policy decision will also be at 10 o'clock in the morning. So you will be 30 minutes into the regular trading day when that news does come out. And then you're going to get a 5-year bond auction. These bond auctions recently have been moving the markets, but most importantly at 4:35 tomorrow, so after the bell, when you're digesting earnings like from Meta and ServiceNow and the IBM, those other companies, you're going to get a speech from Fed Jerome Powell, and that could move the markets heading into Thursday. And then Thursday's data, well, is probably going to give you a huge move in the broader markets. Last but not least, like Sawyer Merritt says, imagine working at a McDonald's drive-thru and seeing the Cybertruck pull up. This was posted by Mad Moger on Reddit, and sure as shit, there's a Cybertruck, and that it looks so clean too. Like, this one is probably fresh off the line. It wouldn't surprise me if this is an auto reviewer that has in their possession a Cybertruck. A lot of the time, your auto reviewers will get new vehicles before they're actually sent out to the public. We've seen that with the Model 3 Highland. People were reviewing the car before deliveries ever started. Although that was like a 2-3 day difference, they actually had got those vehicles like a week or two beforehand. Just when we finally got those videos that came out, it was like 2 or 3 days before the actual launch of the Highland. So we'll see. I mean, that one does look very clean. Deliveries start November 30th, and the delivery event, hopefully we have some of these reviews out sooner than that, though. That'll be really cool to see. So that is going to go ahead and do it for this video. Let me know what you think about all of this information down below in the comments section. Hit the like button as well as subscribe to the channel if you want to reach financial freedom, drink Bahama Mamas on the beach, or at the very least stay up to date and grow your knowledge base with what's going on here every single day in the markets as well as Tesla stock. My name is Michael Tyler. Enjoy the rest of your day and nights, and I will see you in the next one.